Welcome to Breaking News to Trading Moves. Today we're looking at a really specific split in the market. It's between two big names, two heritage toy makers you'd usually expect to, move more or less in sync.
But they didn't. Not at all.
Not at all. We're talking about Mattel, ticker MAT, and Hasbro, ticker HAS.
It was a very clear divergence. You saw Mattel shares sell off, and pretty sharply, while Hasbro actually rallied.
And, on the surface, you might just think, okay, one of them had a better Christmas with their action figures or something.
All right, but the drivers here are much more structural.
Exactly. This isn't just about whether Barbie outsold G.I. Joe. This is really about how investors are starting to view digital gaming exposure versus, well, traditional toy demand.
That's the core of it. The market seemed to punish that reliance on physical inventory, and it rewarded the digital strategy.
So we're going to look at the winners and the losers that come out of a headline like this, just to understand the broader mechanics at play.
Sounds good.
Let's start with the one that took the hit then, Mattel, ticker MAAT. The stock sold off hard.
It did. The headlines all said, weak results, underwhelming outlook.
So what were the specifics? What was actually going on?
Well, if you listen to what management was saying, they cited pressure from promotions, which is a big one. Also, choppy retailer ordering.
Choppy retailer ordering. That's a phrase that always stands out to me.
It's polite language for a big problem.
For a manufacturer, it's a warning sign, isn't it?
Oh, absolutely. It creates a backlog. And you have to remember, Mattel is in this heavy investment mode right now. They're spending a lot to try and build out their IP strategy, which is already weighing on their margins.
And on top of that,
they're still just so heavily tethered to the risks of physical inventory. I mean, you are moving physical boxes. When the retailers get nervous and stop ordering or demand just slows down, well, you get stuck with the product.
And getting stuck means markdowns. That just kills your profit.
Kills it. You have to clear the warehouse somehow.
Okay, so let's flip the coin. Let's talk about Hasbro, HAS. They also guided cautiously. It wasn't like they came out and said everything was perfect.
No, they didn't.
And yet the stock went up.
This is where the composition of their revenue really changes the whole picture. Hasbro has a piece of the puzzle that Mattel doesn't quite have yet.
Which is?
The strengths from Wizards of the Coast and their whole digital gaming segment.
We're talking about Magic, the Gathering here, primarily.
Specifically Magic.
Yeah.
The Gathering, yes.
Yep.
It's a key driver. Those assets, both digital and the tabletop cards, they helped offset the softer trends in the traditional toy business.
So while maybe fewer people are buying certain action figures,
the engagement with Magic, both physical and digital, it just keeps that revenue engine humming along.
It almost feels like the playbook for how to value these companies is changing.
I think it is.
Yeah.
Investors are starting to value them more like media or IP platforms instead of just manufacturers.
That makes sense.
And if you look at the economics, it's easy to see why. Digital monetization, live service games, they offer much higher margins. And the revenue is more recurring, not like the cyclical up and down of classic toy sales.
You sell a board game once.
Exactly. But you can sell a digital expansion pack or a new set of cards over and over again.
So in this story, Hasbro is sort of harvesting that digital pivot. They've already built it. Mattel is still trying to build its engine.
That's a perfect way to put it. Mattel is chasing that valuation multiple while Hasbro is already demonstrating it.
Okay, so that's the headline. But let's look at who else wins and who else loses when this kind of dynamic plays out. Let's start at the winners. We've got three groups here. First up, the digital and tabletop IP monetizers.
Right. So the concept here is pretty simple. It's companies that generate recurring spend, regardless of the season.
So the logic is, even when traditional toy demand gets soft, these digital ecosystems hold up.
They hold up because they're monetizing engagement all year round. It's not just a Christmas thing. It's in-game spend, expansions, organized tournaments.
We already mentioned Hasbro, HAS. Who else fits that mold?
Electronic Arts is the other big one, ticker EA.
Okay.
They operate on that exact same model. It's not about selling one video game cartridge anymore. It's all about the live service, the season passes, the ultimate team packs in their sports games. That revenue is just stickier than a holiday toy purchase.
It just removes that seasonality risk.
Yeah.
You don't need a blockbuster Christmas if people are playing your game every single Tuesday.
Precisely.
Okay, second group of winners. Gaming platforms.
This is all about the migration of brand spending into these digital worlds. As marketing strategies for toys move online,
Which they all are.
the platforms that host these branded experiences in social play, Well, they see more licensing revenue and more user engagement.
So if Mattel wants to market Barbie, they're not just making a TV commercial, they're building a Barbie world inside one of these platforms.
Right. They're building experiences where the kids actually are. And the landlords of those digital worlds, they win.
So the ticker symbols to mention here would be Roblox, RBLX, and Unity software.
Yeah, Roblox is the classic example. It's basically the digital playground for this generation. If the toy companies want to reach that audience, they have to, so to speak, pay rent in the Roblox ecosystem.
And Unity.
Unity provides the engine, the software that powers a lot of these mobile and digital experiences that brands are building.
Got it. Now, the third group of winners is a little counterintuitive. Retailers benefiting from promotions.
It does sound backwards, doesn't it? You usually think promotions are a bad sign.
Yeah, it means someone's desperate to move product.
But for the retailer, it's all about traffic and value positioning. When a toy maker like Mattel is forced to discount all that inventory, the big box retailers, they win.
Because the cheap toys get people in the door or onto the website.
That's it, exactly. It drives foot traffic. It fills up online baskets. Consumers are hunting for value. So you go to the store to buy a discounted toy. And you're probably also buying your groceries, some household items, maybe clothes while you're there.
So the manufacturer takes the margin hit, but the retailer gets the volume benefit.
In many cases, yes. The toy becomes a loss leader or a traffic driver for them.
And the big names to watch here are obviously Walmart, WMT, and Target, TGT.
Those are the giants that are best positioned to capture that promotional traffic.
All right, let's move to the other side of the ledger, the losers. Who gets hurt when this dynamic takes over?
Well, group one is pretty obvious. It's the traditional toy-heavy manufacturers. This is that inventory trap we were talking about earlier.
The logic being that any company that's mostly tied to physical sell-through just has the highest risk.
Cautious retailers lead to piled-up inventory. Piled-up inventory leads to markdowns and markdowns. Well, they crush your margins. It's a tough cycle to break if you don't have that digital buffer.
And we know Mattel, M-A-T, is in this bucket right now. Who else?
You could look at a company like Jakks Pacific, ticker JAKK. They're smaller, but they face the exact same physics. If the physical box doesn't move off the shelf, the numbers turn bad very, very quickly.
Okay. Group two of losers, collectibles and discretionary names.
This is all about sensitivity to consumer pullbacks. If people are delaying purchases or, shifting away from non-essential physical stuff, these novelty categories see demand soften almost immediately.
It's the nice to have versus the need to have.
And even within toys, there's a hierarchy.
Yeah.
A kid's birthday present might feel essential.
Yeah.
But a high-end collectible statue for an adult, that's definitely discretionary.
Ticker symbols here.
Well, you could look at Cedar Fair, ticker FUN. They're a theme park operator, but they're so tied to that discretionary spend and merchandising. And maybe Bath & Body Works, ticker BBWAI.
That's a different sector, but I see the connection.
It's the same consumer psychology. If people are pulling back on buying extra toys, they're probably not splurging on extra candles and lotions either. It's about the total wallet share for stuff.
Right. And the third group of losers is media and licensing exposure.
This is about the lag in royalties. If the physical toys aren't moving off the shelves, what we call slow sell-through, then the merchandise velocity cools right down.
And that hurts the companies that actually own the intellectual property.
Right. It makes the licensing economics much more conservative. Partners get risk-averse. They might sign fewer deals, or the royalty checks just come in smaller because the volume simply isn't there.
So even the giants can feel this. We're looking at names like Walt Disney, DIS, and Warner Bros., Discovery, WBD.
They are the upstream owners of the content. If the downstream product, the toy, clogs up the retail channel, that revenue stream flowing back to the media giant slows to a trickle.
Okay, so we have the lay of the land. We see who's up, who's down. How do we translate this into trading angles? What's the outlook?
Well, the most direct way to look at this is through a pair trade. You're looking at relative strength.
Can you explain the classic pair trade lens for anyone listening who might not be familiar?
Sure. In this context, it would mean being long on Hasbro and simultaneously being short on Mattel. You're effectively making a bet on the superior business model. The one with digital and tabletop exposure outperforming, the one stuck in the traditional toy cycle. You're not necessarily betting the whole market goes up or down.
You're just betting that Hasbro will perform better than Mattel no matter what. It hedges out some of that broad market risk.
Exactly. You are trading the divergence between the two.
Now, earnings season is always just around the corner. What should you be listening for in upcoming earnings calls for the sector?
There are 3 specific phrases to monitor. First, retailer orders. Simple enough. Are they picking up or slowing down?
Okay.
Second, promotions. Are they heavy? Are they still trying to clear old inventory? And third, and this one's important, digital pipeline investment intensity.
That last one sounds key for Mattel, right?
It is. You want to know how much are they spending to try and catch up to Hasbro. If that number is high, you can expect margins to stay compressed.
And for Hasbro?
For Hasbro, you're listening to see if that digital revenue is continuing to grow or if maybe it's starting to plateau.
It really feels like we're watching a transformation of an entire industry in real time.
We are. The market is telling us pretty clearly that the value is migrating from the physical plastic to the ongoing digital engagement.
Which brings us to a final thought for you to consider. Has the definition of a toy permanently changed? You know, is it no longer a physical object, but maybe more of a digital access key? When you buy an action figure now, is the figure the actual product, or is it just a token that unlocks the real experience on a screen?
That's a question that every investor in this space really needs to be asking themselves.
Before we go, I need to read our mandatory disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for joining us for this breakdown of the toy market. We'll catch you next time.
Goodbye.